Excellencies, distinguished guests, ladies and gentlemen, please allow me to stand on established protocols for want of time. It is my great pleasure, on behalf of the African Development Bank Group, to present to you today the key findings of the African Development Bank's Africa's Economic Outlook for the year 2023 on the theme, Mobilizing Private Sector Financing for Climate and Green Growth in Africa. The report is in 3 chapters. The first one looks at the outlook for Africa with regard to macroeconomic fundamentals. The second on how to harness those to mobilize private sector financing to drive climate and green growth in Africa. The third looks at how we can leverage the huge assets we have on the continent, natural capital, to be able to drive inclusive growth and climate for development in Africa. Then we will have recommendations, which we try to focus on clear, practical actions that can be taken at different levels by different stakeholders. I'll get to that. Let us just get into the first chapter of the report. In the first chapter, we look at Africa's economic outlook. As you can see on this slide, the outlook is positive. Despite the confluence of shocks that we have discussed here, the COVID, the climate, and also the conflicts, and also structural changes, issues that remain on Africa's economy in different African regions and countries, the continent grew by 3.8% in 2022. This is higher than the 3.4% of average growth globally. Looking ahead, we see an acceleration of that growth path, with 4% projected at the end of 2023 and 4.3% projected at the end of 2024. And 5 of Africa's fast-growing economies are set to return to the league of the 10 fastest-growing economies in the world. I think Africa needs an applause. But this performance and outlook is not the same across the regions. There are always heterogeneities depending on economic structures, dependence on natural resources, and other factors that you will find when you read the report in detail. I want to point out, for want of time, credit to Eastern Africa region. This region was the only region that escaped recession during the COVID-19 pandemic and has continued an upward trajectory in growth, with an estimated 5.1% GDP growth in 2023, that will continue to go higher, even to 5.8. Southern Africa, on the other side, continues to face strong headwinds because of structural issues, energy shortages, and other factors were already discussed in the macroeconomic outlook report launched in January this year. But all the other regions, the central, the western, the northern, maintain also positive trajectory in growth. So the resilience of Africa's economies cuts across the regions. We will be releasing next month, regional economic outlook reports to have deep dive analysis on each regions. And in July, we will come to you with the country focus reports that will try to have deep dives on key actions that each country needs to take depending on their own peculiarities. But this growth projection that we share, if I go back there briefly, I want to make a point on the right side of the slide there. You'll find different economic groupings on the continent depending on economic characteristics, dependence on tourism, dependence of natural resources, resource-based economies, and so on. And then you find that only one of that is actually continuing the trajectory of upward growth. We saw and reported to you in 2022 the resurgence of growth in tourism-dependent economies, but this is now going down because of the tapering of savings that we have in these tourism source countries. But when you look at the other ones, you find that the non-resource intensive economies, which are much more diversified, continues to go forward with recovery. So our projection is that such economies will continue to show marked resilience in the coming years. But overall, a positive outlook. But that positive outlook comes with cautious optimism because we still continue to have challenges in several macroeconomic fundamentals and their underpinnings. Here we can see, because of the fiscal conditions around the world and the consolidation in fiscal policy and monetary policy, we're seeing exchange rate devaluations across several countries of this continent. And that also leads to consumer price inflation, which we project will rise further to 15.1% at the end of this year. But the good news is that our projections show that it will go back down to below pre-pandemic levels by 2024, if all conditions remain the same. The third one, the second issue we need to raise in the macroeconomic fundamentals is the issue around debt. And we have all been talking about it. Debt vulnerabilities continues to worsen because of rapid exchange rate, depreciation, as I've already talked about, but also high primary deficits. Even though we also expect that this trend will go down in terms of debt to GDP ratio in the medium term, one point I need to make here is the right slide there, where you see that the drivers of public debt, when you do a decomposition, you find that the debt creating flows points to the same issues I've raised. Projected exchange rate depreciation and high primary deficits will have greater cumulative impacts on external debt dynamics in Africa, even more than the historical debt drivers, such as GDP growth. Why I'm stressing this is that we all know where the source of this inflation, the source of exchange rate dynamics in Africa comes from, the strengthening of the dollar and some other external factors, but there are also internal structural factors that different countries need to deal with. So because of this confluence of factors, we find that also debt, the cost of debt service is going up rapidly. And this is raising significant concerns in the financial markets with regard to potential sovereign defaults across countries. The report goes into depth regarding debt because of its importance, but time will not allow me to go deeper to look at that at this time. But if you just look at that figure, you can see that we have risks to watch in Africa's macroeconomy. Subdued growth and softer demand in Africa's export markets continue to be a challenge, might deepen if Russia's invasion of Ukraine continues. High interest rates, high cost of debt service, also associated with debt distress and potential sovereign defaults, as I've mentioned already. But the physical impacts of climate change is also creating major challenges, as it often washes off hard-earned physical infrastructure and then have to be rebuilt, and that is creating significant challenges with regard to fiscal sustainability on the continent. But one that continues to remain a concern is commodity dependence and price volatility in the commodity markets. That makes it difficult for countries to plan. It makes it difficult to be able to get enough domestic revenue to address the fiscal challenges that we have. In the last slide, I will come back to policy recommendations and actions that needs to be taken to address this. Let me just, after that snapshot, go into the second chapter, which is private sector financing for climate and green growth on the continent. This is the theme of these annual meetings, and we've had our leaders intervene on their opinions regarding this. I have learned quite a lot from those discussions. And one thing that comes out clear, and it's also what the report settles on, is that the public sector cannot do it alone. We need the private sector. But needing the private sector doesn't mean that the public sector should scale down its financing. And you will see the reasons for making that statement as we go into the report itself. First, debunking what used to be the thought that there are significant trade-offs between going green and doing climate smart development, poverty alleviation, and other socio-economic goals. We find in the report that green growth positively correlates with GDP growth. It also correlates with climate resilience and climate readiness. So embarking on green growth, which is what we're all talking about, and climate resilient development can actually be a source of addressing the long-lasting development challenges on this continent. So if you look at that, then you think about what I call Africa's green development paradox. And you have that in natural capital, you have that in population and human capital, you even have that in knowledge capital for Africa, where you have abundance but scarcity. So here, just on the left side, the market size of Africa, almost $3 trillion, a population of 1.4 billion people. That's significant human capital, the size of China. But it's projected to go to about 2.4 billion in 2050. Mostly youth, innovative, creative, and ready to explore the world. We have significant natural resource endowments. We have talked about green minerals in Africa, the 65% of uncultivated arable land in Africa. We've talked about 30% of mineral deposits, and several, just name it. Everything is here on the continent. And if I quote the president of the African Development Bank, Dr. Deshina, at his opening speech, he says, God really loves Africa. So with this, you also see that Africa has green technology potentials. I'll just give one example. Renewable energy, which we all talk about. The technical potential in renewable energy, 44.8% of that potential is in Africa. And we also have low legacy in high emissions infrastructure. So it's easier for us to build these climate resilient green infrastructures that we've been talking about. So instead of having a latecomer we have a latecomer advantage, as one of my favorite professors, Professor Yeyinka, had written in a book many years ago. So we can move faster because we don't have legacy infrastructure that we have to try to rebuild and retrofit. There is also high and growing political will for climate and green growth in Africa. And COP27, hosted by the Arab Republic of Egypt, was a clear example. This meeting, clear example, heads of states, prime ministers, ministers intervening, and everybody is one voice. Africa needs to act. The world needs to act to support Africa, and global financial institutions need to be reformed to support Africa better. But here is a paradox. You look at the right side there, you find that when you look at all the 40 global green growth indicators, Africa is not doing well. We are underperforming our potential. It's the third there, just doing better than Middle East and South Asia, but running behind East Asia and Pacific and all the other regions that we've mentioned there. A continent that has 48%, almost half of a potential in renewable energy. We should be leading not running behind others. You go to think about the private sector, which is the topic of this chapter. There's also very little appetite shown in investing in this huge market potential. With all we have said already, I could say, and I hope you would agree, that Africa is the current and future market frontier for climate and green development in the world. So when I look at this report, I'm wondering what is the private sector doing? Here is opportunities to make money and deliver global public goods. So you'll be doing well by doing good. So what are we waiting for? So if you look at the share of private and public financing for climate and climate finance, if we just focus on climate in 2019 and 2020, we look at this side of the graph, you see that Africa is very small. On the other side, you'll find that the total climate finance to Africa, we've already heard that figure, is 29.5 billion. But the private sector has only done the paltry 4.2 billion, only 14% of the total. The other challenge that we found in the report is that the leverage ratio in Africa is far lower than the rest of the world. So for every dollar in public financing mobilized in Africa, we're only able to mobilize, to leverage 0.16% in private capital. In some other regions, that figure is up to 18 instead of as low as it is on the continent. Then another thing that links to what we presented in our AEO, which was a bit confounding, is that climate finance is inversely related to climate vulnerability. So the more vulnerable a country is, the less likely to receive climate finance. So that defeats the purpose of climate finance, especially if that was supposed to be addressing climate impacts. So the size of the need of climate finance on the continent is huge, 2.7 trillion cumulatively from 2020 to 2030. That's about 242.4 billion annually. And if you calculate, if the private sector were to come in and take opportunity, this market share that we're talking about, we have a gap in terms of climate financing needs of 213 billion US dollars annually between now and 2030. And that curve there just shows you the growth rate to be able to meet our nationally determined contributions. And a pause there is just to remind us that if Africa doesn't achieve the NDCs, the Paris Agreement will not be achieved. The Sustainable Development Goals will not be achieved. And this was enshrined in the Paris Agreement, recognizing that there are conditional actions which have to be funded through the global public-private finance. What are the sources and the target sectors of that small amount of private sector financing that we've seen? On the right there, you can see the types of instruments that they've used to fund the continent, that 4.2 billion. But then if you look at the right there, something is also jumping out there. Energy sector, which is renewable energy sector, takes almost 74% of the total, leaving a paltry amount for adaptation, loss and damage, and other social needs that are equally important if we have to address climate and green growth challenges on the continent. That again links to the structure of climate finance as we discussed in the AEO 2022 that is biased against adaptation. So for private sector, there are reasons you will find in the report why this is the case, but the bank also is doing a lot of work in adaptation benefit mechanism and other instruments that can help to address some of those bottlenecks so that climate finance can go into the adaptation sectors. The investment opportunities are huge in all the other sectors. Agriculture, up to 1 trillion market in 2030. Energy, about the same size, 1 trillion. ICT, you see the growth on ICT, that's only for 2023. And we talk about electric vehicles, which is growing rapidly at 22% growth annually. So if you think about all the resource endowments that we have and the cost competitiveness advantage which the president mentioned, it costs 3 times more to build a lithium-ion precursor factory in China and the United States than building it in Africa. So for me, that's actually huge opportunities to reduce cost of production, but another aspect is reducing the carbon footprint of products. Because the current model of international trade, where we trade in raw materials, distant lands, and bring back finished products, carries with it a carbon footprint. We can cut that off. But it can also help address poverty alleviation and also other social development challenges by creating jobs where the sources of raw materials are. And then, if you move forward, you find that Africa is not fully, in fact, I will not even use the word fully, it's not really leveraging this huge market that we are seeing. The president already gave us the figures about the cumulative green bonds of 2.3 that reached 2.2 trillion at the end of 2022. Africa has only 0.2% of that. But if you look at all the other aspects, even the voluntary carbon markets, Africa's share is very low. Every aspect that you look at, the only place that Africa seems to be doing better than other regions is in blended finance instruments. Going forward, what then are the key enablers? Because you'll be asking, why is it not happening? If you look at this side, the answers come very clear. Countries that have less public climate finance will have less private climate finance, because we find on that right side here that there is a high level of complementarity between public finance and private finance for climate change and green growth. The growth of the country, GNI per capita, the gross national income per capita in countries, the higher it is, the more likely that the private sector will come in. Investment risk profile, the lower it is, the more likely that investors will come in. But you also see climate risk score starting to come in there, and the quality of public infrastructure. Why is this important? Growing green does not substitute building infrastructure for development. It does not substitute other development agendas and development goals, because they are all mutually reinforcing. So for me, it's more about inclusive growth, where we triangulate the economic, the environmental, and the social goals of growth. And this report and the analysis you will find just supports that. What are the barriers? Why is it not happening? Lack of strategies and implementation effectiveness. Sometimes we have strategies that are not implementable. And we also have the issue of weak regulatory structures and institutions. We have lack of investment-ready project pipelines. Every time you hear this issue about project preparation facilities being needed, but also we have limited access to international markets for some of the reasons that we've already discussed in chapter 1. Continuing on challenges on the supply side, limited experience by global public investors and private investors is a major issue. People read in articles about risk in one country and generalize risk in all countries. And that creates a disincentive for investment into African countries that are doing well and have very low risk profiles. That needs to change. We have information asymmetry that is deriving from that limited experience and the way we are making investment decisions based on what we read or see in televisions, without really having local knowledge of those countries that we're talking about. And these two leads to the perceived high investment risk in Africa, normally refers to as the investment risk premium on the continent. And credit rating agencies are not out of it, because some of those biases feed into credit ratings, and that leads to higher cost of capital, and it leads to a lot of investor flight from the continent. Let me just dwell on that risk profile issue for a short while. The default rates on the continent, this is studies that were done by Moody's Analytics. 14 years of studies. And then in 2020, they repeated it, and they find that Africa's risk of default in infrastructure investments is around 1.9. Compare that to 12.4 in Eastern Europe, and North America, 6.6. So countries that are not defaulting are not receiving financing. It's really difficult for me to understand. But if you look there, that low default rates and poor investment sometimes is not based on actual experience on those countries. And a study by UNDP shows that if the risk ratings of Africa were done properly and not based on biased information, Africa could save up to 74.5 billion. That's a huge amount of savings. Then we go to chapter 3, natural capital for green growth in Africa. This one I'll be very quick because we all know about that. Here on the left side is the natural capital resource endowments on the continent by type, both renewable and non-renewable. When you get the report, you get the details. But let's look at the right side there, valued at $6.2 trillion in 2018. But the important thing here is to see that even that natural capital per capita is declining from about $4,000 to about 2,800 and something US dollars. So continued dependence on natural capital in terms of without adding value is not a good development strategy. I've already talked about the energy potential, and on the map right side we disaggregate the potentials by regions. Please, I'll call on you to read the report to get more details regarding this. Now, there are ample opportunities on the continent to actually leverage resources from several global conventions and agreements that has been reached already. But as the President had mentioned, these global conventions often are megawatts of talk sometimes, but not megawatts of action. So if we can are serious as a global community and turn those conventions on biodiversity, on climate, and so many other conventions, you'll find them in the report. This is what you will be able to see, including potential financial flows under the Glasgow National Development, NDCs, and so on. Please, I'm not going to go into detail because of time. And Africa has huge natural resource endowments that provide huge opportunities for investments, again, to do good and do well. The Great Green Wall, the President talked about the Desert to Power initiative and other things that the bank is doing, but also the huge potential in green hydrogen on the continent. Every aspect you look, there are huge opportunities for investment. Here, you see that currently Africa focuses on mining and metals, but then precursor production of lithium-ion batteries and all things that is needed for electric vehicles. The higher you go on the value chain, the bigger the market size. So investing more to get Africa to that level is a great way to mobilize resources that we're talking about. What are the key barriers we see in natural resources, natural capital? Of course, resource governance. We all know about the resource cores and other things. These are driven by institutional capacity and weak regulatory structures. Illicit flows in resources that are not accounted is huge on the continent. There's more need for more research to even understand that better. but we also know that there are issues around organized crimes and resource theft in several natural resource sectors on the continent. Political instability often gets correlated or associated to natural resources wealth on the continent, and we don't have natural capital accounting across the continent. That needs to be done, and that also, some of these leads to tax avoidance and illicit flows, which has been estimated to be around 90 billion annually. So that, if we save that, we are mobilizing already huge resources. In recommendations, we focused on what national governments need to do, because all too often we talk about what others need to do for us. But there are several issues. As you can see, this is the busiest slide with regards to policy recommendations. I won't go through all of them because of time. Anti-inflationary monetary policy is key. Please look at the report and you see the specific instruments and how to use them. Coordinated debt treatment, the president has already talked about it, but we need appropriate fiscal reforms and incentives to encourage the private sector to come in. There are very clear criteria that draws investment capital. We need to do that. Talking about it will not bring the private sector because they will always focus on the bottom line. Developing long-term strategies that are clear and well-costed and implementation roadmaps is needed. And all these other things that are there, I will just not go through all of them, including deepening the capital markets and also domestic revenue mobilization, and then project preparation facilities at both national and regional levels. For the MDBs, the president already talked about two key issues that the MDBs needs to do. Let me just try to unpack them a little bit. MDBs need to align operations with the Bridge Time Initiative. We also need to expand concessional financing and grants for capacity building, even for project preparation and other aspects of development, because those will not be invested in easily by the private sector. We need to provide more risk agnostic and catalytic capital. We've talked about risk guarantees. That need to actually look at how to do that more and more so that we can use that to leverage private sector capital coming into this sector for the continent. But on the whole, there's need to revisit the risk appetite of MDBs and DFIs. Because the model we have currently, you've seen, is actually going, capital seems to go in reverse, not going to the places of need because of a lot of the reasons we've already raised in the AEO 2022. Profitability targets is also an issue. We need to think about that and how to deal with it, being development institutions, not profiteering institutions. But we need to scale the use of innovative financing, and the president has talked about a lot of them, but also switching more from project-based to system-wide transition-based projects that has a portfolio of projects that helps to de-risk the environment, the business environment. The project risks associated is very important as well. Private sector rating agencies and international community, their own recommendations for me were very much more straightforward. The three needs to exercise market leadership and stewardship. We cannot be talking about global public goods and the need to save the global commons and acting differently. That is a moral responsibility that we all need to do. Credit rating agencies need to review their methodologies and broaden their rating frameworks so that it becomes fairer and seen as fairer. In Africa, the discussions and calls for having an African rating agency is something that's already ongoing, and that seems to be in a good direction because that can help to provide data and engage with international rating agencies to help improve the knowledge about African markets and potentials. For developed countries, just one recommendation: honor commitments. And collectively, the three should champion and support the reform of the global financing architecture we have all talked about. In conclusion, I end in the 5 points that the president has raised in the opening speech. Establish your national development green growth plans and strategies. Be clear. Establishing them based on your own context, not based on global discussions. incentives for incentivizing green industries through realignment of subsidies and so on, providing guarantees at scale to de-risk the private sector, developing pipeline of bankable projects with high risk-adjusted rates of return, and also the asset recycling that the President has already spoken to us about. Excellencies, distinguished guests, ladies and gentlemen, thank you so much for listening. Let us stand together to harness these huge opportunities for in Africa for driving the collective goal of saving the planet. Thank you.